Hello and welcome to Moneycontrol. This is the Money Show, and it's the beginning of the financial year. So it's a very good time of the year to start planning your taxes and your investments. And this is the three-part special series that we at Moneycontrol have been bringing for you. In the first two episodes, we were talking about the various tax deductions and exemptions that you could have got on your expenses like HRA or home loans, your leave travel, and so on and so forth. Today, I have with me in the studios Amol Joshi. He's a financial planner, and we're going to talk about how you should be planning your tax investments throughout the year and why this is a good time as any time in the year to start planning for your investments and tax.
Sure.
Hi, Amol. Welcome to the show.
Thanks for having me here.
And once you start planning once you've actually already planned your house rent allowance and your rental receipts and leave travel allowance and all your expenses,
Sure.
We want to start the attention actually of the tax saver and the investor turns towards the investments.
Sure.
And usually this is the first stepping stone of the young investor into the investment world.
Sure.
By planning about his or her taxes. Now we'll
Yes.
get to the right way of investing,
Right.
approaching your own financial planning a little later in the show.
Okay.
But can you just give us a brief overview as to what tax reductions we can get from tax saving investments?
Certainly. And in fact, I like this approach. You have clearly segregated into two parts. First one is expenses, which
Yes.
has been taken care of in the previous parts. Let's come to actual investments. So investments, within investment, ATC is probably the section where you would want to invest into the qualified investment avenues or investment instruments and thereby claim the tax benefit. There are very many number of instruments which you can actually invest and claim tax benefit. So let's start from the simplest. Since you mentioned young investor or young earner, the easiest and most common would be employees provident fund deduction.
Okay.
So the deduction that happens from your salary, that's number one. I'm sure most of the parents would have wanted or would have told the young investor to invest in public provident fund. So PPF is something else. You could also invest in any pension plan or a child-related childcare plan that also qualifies for tax exemption over here. And one very good product which is equity linked savings scheme, which is a mutual fund a product that qualifies for under section ATC tax benefit. Last but not the least, let's not forget NPS, National Pension Scheme. So NPS has a separate section of 50,000 as well as NPS 2 can qualify for a 1.5 lakh rupees deduction under section ATC. So these are all the number of instruments that we can certainly look forward to and plan right at the beginning to extract the entire benefit.
ATC, you said, is the one that we should keep an eye out on.
Sure, that's correct.
Now, one of the big problems when we encounter people who are planning for their taxes throughout the year is that, there's so much of emphasis that goes around tax investments that, people tend to sort of forget the overall, the need to sort of plan their finances and look at other issues like liquidity issues or planning adequately for their goals or for the near term or their mid-term goals also. So as a financial planner, what do you suggest? How should you approach tax investments? I mean, is tax investments to be taken only in isolation or should it be a part of your overall financial goal?
I have no better way of saying this, that tax planning, if you look at it as a standalone exercise which is cut off from your goals and financial needs, then that would be probably a big mistake. All the investment instruments that we spoke of, each one of them can be earmarked for a separate investment goal or a separate life goal that one may have. So let me start from the farthest end. So anything that has to do with pension or anything that has to do with retirement corpus, you can probably invest into NPS and you can allocate your employees provident fund deduction from your salary. So that can be towards a long-term goal. That's really long-term goal. So something which is fairly long-term, let's say 10 to 15 years, if you have an ongoing PPF investment discipline, if you have an ongoing PPF account, then PPF can be allocated for that, as well as PPF, as we all know, is a 100% debt allocation. So it's a safe, secure and a non-equity or non-market linked allocation. So PPF can be allocated towards a safe sort of a corpus that you want to create. Coming to okay, so in earlier part we probably missed out on insurance. So insurance that you insurance for two purposes, obviously. One is term plan, which is purely expense. It is not an investment.
Obviously.
But second one, a ULIP. So that card, a ULIP or mutual funds or a short-term investment can be looked at for equity oriented or a market linked goal, and you can stay invested for a medium to long term, let's say 3 years, 5 years, 10 years, and you can, and that's how you should plan. So I would say, I would like to repeat here that tax related instruments should not be done probably at the last moment, because you will not be able to allocate right amount of time and study, will not go into it, and you will not be able to make the most of it.
And also there's a lock-in also, so you need to
Yes, of course, of
all
course.
these tax investments come with a lock-in. So.
All the investments, this is the characteristic of all the tax related tax beneficial investments, all of them do have certain lock-in. So you cannot be investing a chunk of your money, let's say 1.5 lakh rupees, which you are likely to need 3-4 years later, 5 years later. You cannot be investing into a 5-year lock-in product, let's say for example ULIP, or let's say PPF that has a, you have just started and the, you cannot really redeem at a quick interval. So that would be a mistake. So you're right in pointing that out.
So Amol, you've spoken about a range of financial instruments, tax-saving instruments. I specifically want to focus on two investments. One is the PPF and the other is a tax-saving mutual fund investments. So PPF comes with an 18-year, it's an 18-year instrument. 15-year instrument.
15 years.
You think that it's a appropriate instrument for people because given a long lock-in, I mean, how do you actually use it to your own benefit?
Right. So PPF, make no mistake, PPF is one of the best investment and tax planning vehicle that you can get. There is only one minor downside, that it does not have an equity or stocks related component. So the returns upside from that point of view is limited, but it has many number of benefits. Let's start with the most important benefit. It has a triple E status. Triple E status simply means exempt during investment phase. So you can claim ATC benefit, and exempt during the interest accumulation phase. So it's a 15-year product. So all the interest that gets credited at the end of each year, it does not get added to your income. It is tax free. And third E stands for exempt during the redemption or exempt during the maturity phase. So when it matures, it does not have any tax liability. So it does no tax liability arises at all, neither on the interest earned nor on the entire maturity proceeds once you receive.
The whole bulk of money that you get at the end of the 15th year when you withdraw your PPF, nothing gets.
That's correct. So it's one of the best instruments. Till 1 year back, till 2018 finance budget, you had ELSS also completely exempt. But that benefit had slightly reduced. Now there is long-term capital gain tax of 10% which is applicable. So other than one minor I would say, despite of being a 15-year long horizon and 15-year long investment product, if there was any equity component, it would be greatly beneficial, but it is not there in PPF. So you can keep your debt allocation into PPF to the entire extent of 1.5 lakh or to partial extent of maybe 50,000 per annum over in PPF, and maybe remaining component, whatever, depending on your risk profile, remaining component in probably market linked instrument, so that you are able to get the upside that equity is likely to generate over medium to long period.
And speaking of market linked, tax saving mutual fund, ELSS, you still recommend ELSS despite the capital gains tax?
Oh yes, I would certainly recommend. So PPF rates are somewhere close to 8% or so. PPF rates are also revised periodically, almost every quarter. PPF rates are likely, if the overall interest rate scenario, overall interest rate regime, we go into a low interest rate regime, PPF interest is also likely to go down. On the other hand, since there is 10% capital gain tax, we have seen that with a decade plus or such an investment horizon, equity has comfortably generated double-digit returns. Now, from that double-digit return, let's say 12%, let's say 10, 12, 14%, any number that you take, 10% capital gain tax from that, even if you deduct, if you get a 12% return, 10% long-term capital gain would be 1.2. So you are still making 10.8 post-tax return, which is substantially higher than a comparable PPF instrument. But one step I would go at this very juncture and I say, these are not strictly apple-to-apple comparison. So keep your debt allocation in PPF or the Employees Provident Fund if you have a substantial deduction going from your EPF, and keep remaining allocation in equity-oriented instruments. Within that, ELSS is beneficial because it has one of the shortest lock-in period that you can think of in a tax-saving instrument. You have only a 3-year lock-in.
Thank you, Amol, for joining us and for your responses. That's all we have for you today, folks. For more news and updates, log on to moneycontrol.com.